What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. All right, I am back with another edition of the Macro Insights podcast. And before we get started, I want to let you know that I got a very special guest here in the green room waiting for me. We're going to go over the overall macro environment, the global, how that's kind of global landscape is shaping up, how markets are reacting, and much, much more. So stay tuned for that. But first, big shout out to my sponsor. I got Idaho Armored Vaults. They're at goldsilvervault.com. You can check out Idaho Armored Vault there. They were founded in 2008 with the goal to help you protect your financial assets and give you access to private property outside of the financial system in the precious metals market. So they're uniquely vertically integrated. They have a great structure, procures, transports, stores, provides extensive liquidity using precious metals. So go ahead and give Bob and the team a phone call or visit their website at goldsilvervault.com and tell them Green Candle sent you. All right. Now, let's get into the episode with Matthew. Matthew, how you doing today, man?
Doing great. How are you?
I'm doing all right. I'm powering through. It's a Friday before Memorial Day weekend. So, before we get started, why don't you tell everybody in the audience a little bit about yourself and, what got you to where you're at today?
Sure. So I run a firm called Tuttle Capital Management. We're an ETF issuer. We do a lot of different things in the ETF space, but, kind of my passion is designing tools for retail investors, and then helping educate them. So I've been on Wall Street for a long time, started off in financial services in 1991, been trading my own account since the mid 80s. And, one thing that I've really noticed throughout the years is, Wall Street tends to be unkind to people who, aren't educated about finances. So, we write a daily newsletter, try to do a lot of education over social media, and again, provide products that are, either tools or standalone vehicles for retail guys. So we did the first, actively managed SPAC ETF back when SPACs were hot. We were the guys who created SARK, the ARK ETF, when, we saw that the market was likely to sell off a bit or more than a bit. And we're the guys, we were involved in the launch of the first single stock ETFs in the US. And we also did SGIM and LGIM, long Jim Cramer, short Jim Cramer. So we do a lot of stuff like that. And I've got a huge amount of stuff in the pipeline. So a lot more ETFs coming this year.
That's awesome. But first, you said something there that's kind of interesting that I want to dive into a little bit more. You said you provide tools for, retail investors who are, the market isn't really kind to people who don't understand finance. So, I guess, what do you mean by that? Is it more so like the company balance sheets? Is it kind of, just the general metrics like PE ratio? Like what kind of things are you?
No, so I'm really talking more about financial services. So, you've got a lot of people in financial services advising clients who, aren't on the same side of the table from a compensation standpoint, commissions and things of that nature. So you never really know, do they have their best interest or your best interests? You've got, a pervasiveness of buy and hold, shorting is bad, asset allocation. Don't worry, you're a long-term investor. It's going to come back. And, to me, that stuff is just plain stupid. At the end of the day, though, there are a lot of good advisors out there, too. Problem is, if you're not educated, you're not going to know the difference. A lot of people who have amassed a lot of assets in this industry have done it because they're really good at what they do. And there's some who have done it because they're really good at sales. And, I want to make sure that, people are as educated as possible. So you know what you're doing. I also want to make sure they're as educated as possible. So if they decide, to do things on their own, they don't blow themselves up. Like, I saw a lot of people do last year, which is unfortunate.
Yeah, so that brings me to like the current macro environment, right? You've seen a lot of cycles, get starting with your own personal portfolio in the 80s. And then, obviously, we've seen the dot-com boom, 2008, and what's going on now. So, it is kind of interesting, at this point where we're seeing obviously the Fed raise interest rates at a skyrocketing pace. And it seems like everybody's seemingly tracking that metric, CPI and all that kind of stuff a little bit closely, are closer now than they ever have. So, I'll leave it a little broad. Where is your kind of like overall view on the current macro environment, and where do we stand today?
This may very well be the craziest environment I've ever seen. So, you've got a small group of stocks that have gone parabolic that make up a big part of the indexes. So when you look at the indexes, it looks like we're in this great bull market. You take them out of the indexes, and I believe we're either down or flat for the year. And down or flat for the year from, a macro standpoint, if you said, hey, Fed's raising rates, economic numbers are slowing, inflation's still pervasive, we've got a debt ceiling issue, are we going to have a soft landing? If you tell me all that stuff and say, hey, the market's flat to down a little, that's going to make sense to me. Like, okay, we had a bad down year last year. Now the market's waiting and seeing. These stocks going parabolic doesn't. But I am a huge believer in the idea that you trade based on what you see, not based on what you think. So, certainly you can have your thoughts in the background. And in the background, I'm bearish. Every time the S&P gets to 4,200, my inclination is to fade that instead of to, go in buying. But, I'm not one of those perma bears. I mean, you see it on Twitter all the time, bearish, everything's bearish. And, these guys have to be getting killed, so, we'll buy the stocks that are going up. We'll buy them with the understanding that what's happening is not rational. And, and I think it's a lot like what we saw in the dot-com bubble, where you can make a lot of money on the upside. You don't want to be shorting that stuff, but you also got to be prepared. At some point, the music stops and you've got to get out and or get short. But, you don't fight it while it is. I mean, now we're sitting here, market's getting to 4,200. I'll probably, add a little bit more short exposure because, you've still got sectors that are eminently shortable: regional banks, commercial real estate, private equity, consumer staples. We just started shorting medical devices. I missed utilities, but, hopefully I'll get another shot at those. So there's a lot of places to short, but I'm not going to short Apple, NVIDIA, Microsoft, all those guys. That's just asking to get your ass kicked.
Yeah, I mean, it seems like, you kind of lined it out too. Like I kind of have a similar theory as you, at least from what it seems, the brief explanation you have is like the market hasn't exactly been rational. It seems like there's a lot of cracks under the surface. It seems like, there's kind of two camps when it comes to the recession, right? The people that are looking, backwards looking at the data, they're generally saying that, we're not in a recession yet based on previous metrics and kind of like, what we're seeing on this data that, obviously is backward looking. But, there's also the camp that thinks we're either in a recession or we're going to be in a recession by looking forward and seeing, one, like student loan debt still hasn't been open for payments. to obviously the regional banks and, commercial real estate that you lined out a little bit earlier, have not been performing very well, to say the very least, right? Obviously, the big bank failures and other things like that. But so I guess, because the market isn't being rational, and it seems like Jerome Powell is going to be in the camp of higher for longer. Obviously Volcker was kind of his, I guess, I don't know if you want to say if the right word is idle or what, but he's kind of basing his strategy off of, what Volcker did previously, which is, raise, raise, raise. So, with commercial banks and real estates hurting, like, well, where do you see our commercial real estate and regional banks hurting? Like, where do you kind of see us going from here? I know you said, like, the market, the way it's reacting is kind of irrational at this point, but it doesn't seem like the overall economy has kind of, I guess, the general consumer hasn't really felt that pain just yet. So I guess, like, in your I'm kind of putting you on the spot here, like in your theory, like where do you kind of see it going? Do you think the consumer is going to be resilient enough to, I guess, hold this off, or are we in for some pain ahead?
So I think we're in for some pain ahead. And I would argue the consumer is feeling it. One of the other areas we've been aggressively shorting are the retail stocks. And they've been getting their butt kicked the past couple of days, because I think the consumer can't afford their stuff. So that's been something we've noticed. What also worries me is you've got the guys who said inflation was transitory, who caused this problem with, quantitative easing too long, who are now, we're saying, hey, fix it. And the problem also with the fix, so right now, let's say you're poor or middle class. You can't afford food, you can't afford gas, but you've got a job. What the Fed is saying to you is either A, I'm going to raise interest rates. That's going to mean you can now afford food and gas, but you're going to lose your job. Or we're going to let the crisis going on in regional banks slow the economy, which will slow inflation, which means you'll be able to afford food and gas, but you're going to lose your job. To me, that's not a great trade-off. If I were in that spot, I'd say, you know what, let things stay too expensive and let me keep my job. Because the projections of where unemployment needs to get to for them to get down to that 2% inflation target, I mean, when you state it in terms of percentages, it doesn't seem like that big a deal. But when you realize that's millions of people being unemployed, I don't know. That's not how I would run things if I were Jerome Powell. So, I think we have not yet seen what's going on in commercial real estate. I think you've got private equity stuff that at some point's got to get marked to market, and that's going to get ugly. So my guess is it gets worse before it gets better. But again, we're going to trade based on what we see. I don't recommend going in and just shorting everything with both fists in anticipation of things getting worse, but certainly be cognizant that all is not well out there.
Yeah, for sure. And I mean, Powell's got a very tough job, but it seems like the theory that, Powell's kind of playing under is like at least, my interpretation is that, like, one, fighting the, by raising interest rates as quickly as they're doing, the United States, their number one export is the US dollar. So it's kind of tightening that offshore dollar market in a sense, weakening everybody else a little bit faster than it's weakening us. So, obviously we've had like kind of this global economy where everything's been connected. My theory is that we're going to kind of move to more of, I guess like nationalistic perspective where, more countries are going to have to be more self-sustained. There might not be as much global trade or reliance on other countries because we've seen what's happened with Russia and other things like that. So, but it's also like, all right, well, we're still going to feel the pain in the United States, and there's going to be a lot of pressure, whether it's from, the current administration or from, outside voices, as the US has the global, reserve currency as it stands right now. So in a sense, you said if you were to be, I guess, in Powell's shoes, you wouldn't be necessarily doing it the same way he's doing it. So what I guess would have been your method, or I guess Monday morning quarterback right now.
Above my pay grade, luckily, but certainly would not have kept rates artificially low for as long as they did. Wouldn't have been doing quantitative easing when everything was fine. Um, and, sort of interested to see what would happen in a world where the market decided interest rates. And, maybe the Fed was a lot more hands off and just kind of came in, if there was a crisis, a Lehman Brothers moment or something like that, where, all of a sudden the mechanisms of the free market break and they've got to step in. But, all things being equal, I'm a huge believer in the free market. But yeah, having somebody there just in case the free market breaks, which it can do and in which it's done. So yeah, I would like them to stay out of things as much as possible. I also don't like the idea of Fed speakers. I mean, I'm trading all day, every day, and now you've got to trade around the Fed speakers. So hey, I want to buy this or I want to short this, but oh, you know what? So and so is coming out at 11 o'clock. Let's wait, because they may say something that is totally the opposite of what the guy at 9:30 said. If you're going to be around and do your thing, do your meeting, have your press conference, and shut up.
Yeah, and I like that. I like that kind of saying too, because it makes it difficult. And it seems like the market is very reactionary on all the kind of macro events that comes out, whether it's a Fed speaker, the CPI print, something happens at 2:30 in the afternoon. You'll see giant swings, whether it's dovish, hawkish, or whatever bird metaphor you want to use. So, in your sense, because of I guess the spread of information now, whether it's Twitter or Reddit, like Wall Street Bets obviously got really popular with the GameStop boom and everything like that. Do you think that it's more because of the spread, the like speed of information and kind of how people are connecting and talking that way, like with the internet and social media and that kind of development? Or has this been something that's kind of been a trend for a while and is kind of just, I guess, more like increased a little bit more now that market volatility is kind of, I guess, a little bit more significant than it was maybe a decade ago?
So no, I think what's happened on social media since COVID has really changed everything. The connectivity that people have, the groups of traders who, maybe on their own aren't going to move the market, but, now you have a whole Discord group, all getting in on the same play, and then letting another Discord group know, hey guys, we're doing this. And, guys who have, a million followers on Twitter saying, we're into this. And, then the zero DTEs. And then on the other side, you've got the institutional investors, the smart ones who see what's going on and they figure out ways to profit from it. And I really do think it has changed market structure, entirely. And, I don't see us going back. I mean, retail guys now have more power than they've ever had. I mean, they're not going to want to give it back. I mean, imagine an army of retail guys taking down a multi-billion-dollar hedge fund. If you had told me that 10 years ago, that's not possible. They would just scoff at that. But, the zero DTE options and, how that's impacted things. I think market structure has changed. And, if you're out there trading markets, you have to adapt to it. So, like I said, I've never seen anything like this before. So I'm not going to apply the same rules I might have been trading with 10 years ago to this market.
So in that sense, like how has your approach kind of changed in a sense because of that? I mean, I know you kind of lined out some of the ETFs you had, like shorting Jim Cramer. It seems like that's kind of like, a popular narrative on Twitter. Are you kind of, I guess, a little bit more plugged in onto like, what people are saying that in that sense to kind of see, what I guess the narrative is going around on social media, so to speak?
Oh yeah.
kind of
Yeah.
helping you.
So I mean, I've got CNBC muted. So I don't listen to that. Every day I'm in front of 3 Discords and Twitter, and and I'm looking at that more than I'm looking. Well, and then like 40 charts, but I'm listening to what's going on in the Discords and Twitter, not what's going on CNBC. That's my information flow. I do want to see what these guys are doing. And my philosophy has changed. I used to be much more into breakouts, momentum type of stuff. Now I'm not. If I see something breaking out, not NVIDIA, but I see something, something else breaking out, my knee jerk is I want to find a spot to short it. I don't want to find a spot to buy it. Whereas, a couple of years ago, I'd see something breaking out, be like, all right, I want to buy into that breakout. And, I'm looking much more to buy things that are dipping into support. And my holding period is much shorter than it's ever been. Sometimes my holding period is a few minutes, couple hours. I can't imagine beyond like an Apple or a Microsoft or something like that I'm holding on to anything, short or long for, more than a week.
Yeah, and I mean, it seems like that's kind of like the narrative now, right? Is like things are a lot more, I guess, quickly moving in one way or the other. So I mean, has your approach, in a sense, like just changed dramatically in that sense? Because it seemed like the narrative for quite some time. I was like learning about the stock market in the 2010 era up to 2020. So everything I felt like I learned at that point just kind of was thrown out the window when GME and all these other things were taking off. But it seemed like the narrative there was like, all right, just buy and hold the S&P 500 or whatever index it is, because it's going to go up eventually, and like no matter what cost basis you buy, just dollar cost average in. But the methodology you're kind of describing now is like, hey, like you need to know when you can get in, when to get out, and you need to be quick with those decisions. So do you think, I guess that's like, in a sense, like kind of the way forward? Or I mean, obviously it's not financial advice or anything like that, but is that the way you're kind of approaching it now?
So yeah, the financial services industry is always going to tell you, buy and hold an index fund, dollar cost average, all of that stuff. And the reason is A, they don't know any better. And, B, they want you buying their stuff and they don't want you selling it. I know as an ETF issuer, it's great. Oh, we just got 20 million into our fund today. That's awesome. And then 3 days from now, oh, we just got 20 million out. They hate that. So, they're going to sit there and say, buy and hold, put more money in, don't take money out. And if you're sitting there at a loss, you're a long-term investor, it'll come back. That's going to always be. I've always thought that's stupid. I will continue to. But if you're someone who says, look, I want to see if I can do better, which you don't have to, because doing better is a lot of work, which means a lot of education and spending time. And if you're working 9 to 5 and stuff like that, I mean, you just buy an index fund because you're going to end up blowing yourself up. But if you do want to do a lot better, the narrative that I grew up with was trend following, momentum. Something starts being strong, you buy it and you ride it. And, but the markets were different, where, you'd have the Fidelities of the world start to get into something and you'd notice it start to pop. So you get into it and you ride it up as Fidelity and Vanguard and all those guys are, buying more and more and more. And, you see a lot of these kind of, old time, disciples of Stan Weinstein or Bill O'Neill show you charts from the 90s of, hey, I bought Yahoo at 3 and rode it up to 3,000. And that's all awesome. I don't think that works right now. And so, instead of trying to find something, to buy in and ride it up for, 1,000 points, I'm just trying to make money. trying to buy something. All right, it hits support, it starts to bounce up. Let's buy it. All right, we made 5%, starting to curl down. I'm out of it. So take profits where you can find profits, and you're probably not going to find those monster trades that people thought found in the 90s. Maybe the market will get back to that at some point, but right now, and another saying I like to tell people, trade the market you have, not the market you want. And the market you have is, you got to take your profits when you got them.
Yeah, and that's funny because when I was learning about investing, you always look back at like Warren Buffett, who's obviously one of the more famous investors of all time, and his like kind of corny rules was like rule one, make money, and then rule two, like see rule one. So I mean, at any time you can make a profit, you're doing pretty well, right? I mean, that's obviously the goal with this whole thing. So but it does seem like there's a lot more, obviously like waves in the market and other things like that. You talked about like a lot of, potential short positions where, the consumer, regional banks, commercial real estate, all that kind of stuff is potentially hurting. But, whenever there's a difficult economic time, it always seems like there's a sector or two or three or whatever that outperforms the market and seems to do well. You don't have to give us all the secret sauce or anything like that, but do you see like any sector or anything that you're kind of keeping a close eye on that you think, based on the underlying economic conditions, there might be something to some maybe a company or something like that to find where, you kind of got your eye on that they might outperform just based on, the circumstances.
Yeah, and let me step back, because you did say something important I want to hit. You brought up Warren Buffett, and I grew up with Peter Lynch, and people like to point to those guys, and they had great success. The problem is they grew up in an environment without the internet, where if you were smarter and worked harder, you could succeed. You could find information that nobody else knew. I don't think you can do that anymore. I mean, I've got a Bloomberg, I've got the internet, you've got the internet. I could work for hours and hours and hours. I don't think I'm going to find the one hidden gem that nobody else knows. So I don't think we're going to see another Warren Buffett or a Peter Lynch. Now, to your question, there really isn't. This market is AI on the long side and pretty much short everything else. We have at times this year been long the gold and silver miners. We're not right now. I am watching them very closely for maybe an opportunity to get back in. So that's one area. The oil stocks, I mean, I'm trying to be long the oil stocks. It's very difficult right now. If you put a gun to my head and said, Matt, you got to buy something other than AI, then I'd probably give you like an Exxon Mobil or, something along those lines. But I'm not buying those things hand over fist. There really is nothing I'm seeing at the moment on the long side beyond the AI. I've got a colleague who likes to call it Fang and Friends. And, that's pretty much all I would buy on the long side at this point. And be careful with it, especially as the market tests that 4,200 level again, because, that hasn't been kind in the past. So I'm much more focused on finding stuff on the short side at the moment.
I gotcha. But you did bring up AI, which obviously is like a hot button topic these days. But I'll tell you a little bit about, I guess, my potential thesis behind it, and I want to hear what your thoughts on it. But I mean, obviously, we've just seen we saw 2000 the .com boom, and then early or I guess late 2010s to early 2020s time, we saw a lot of like these crypto companies kind of boom up and pop off from there. And of course, like a lot have failed since then. But now on top of that, it seems like we're kind of moving towards the AI boom, where any company that mentions AI in any sort of earnings call or leaking that they're starting to work on AI or integrating AI into whatever business that they have, seemingly it's starting to take off. But obviously, there's going to be some winners and losers in that aspect, and and all that. So do you think that we're going to, I guess, kind of enter into, seemingly another boom, but, I guess it towards AI? Or do you think this might be like, maybe a little fad that, I mean, I know you said you're long, but it seemed like it could be a potential fad where a lot of these companies, invest a little bit into it, but realize like, hey, this is a tall task to choose. So, maybe they end up dropping that project down the line.
So I think you got to be ready for every scenario. I don't think it's a fad because it's got the ability to change everything. Imagine a computer that can think faster than a worker. How many, and basically at a lower cost, how many workers do you replace? What efficiency do you add? I think you're going to see, AI fundamentally change the entire landscape. And, I think anyone who's, younger in college needs to really start thinking about, hey, this field I'm pursuing, can a computer replace me, and might want to rethink what they're trying to do. And, in the money management field, I think any portfolio manager who's a closet indexer might want to, start sending some resumes out. I really do think if companies can deliver on that promise, AI can fundamentally change the landscape. I think like the internet boom, you're going to have winners and you're going to have losers. I mean, during the dot-com bubble, you had a lot of companies that ran up really, really high that are no longer with us. You had a lot of companies that you assumed would be the leaders who are no longer with us. And, the real leaders emerged. And, we're not going to know who those are right now. But yeah, I do think it's got the ability to fundamentally change things.
Yeah, and I agree with you there. Like, I think, as far as like technology goes, I mean, we're seeing like a difficult environment for, smaller businesses, right? I mean, we're seeing, $15 minimum wage kind of come up in a lot of areas. So whether that's your view on whatever your view on it is, it doesn't matter. At the end of the day, that's going to be raising the capital expenditures of any underlying business. So, we're seeing companies like McDonald's try to automate, certain stores and other things. So I think that's going to be a trend that continues, unfortunately. But, what that kind of, I guess, like tinfoil hat time for me, it seems like that's going to require every single person to have either A, like higher qualifications, or B, like be more educated in order to get, the lower level jobs, which seems like it's kind of maybe it's doom and gloom. I don't know, but it seems like it would not make up well for, I guess, the younger generations in the past, or maybe they become more efficient. I don't know, but with the integration of that, do you see like there could be some potential, I guess, negative layover effects from it, or do you think, I guess, as humans, we'll just adapt to the times and just sort of figure it out in that sense?
I mean, I think it's going to be tough. There's going to be a lot of shifts in things. Again, there's a lot of professions that a thinking computer can replace. And, you've definitely got to be concerned about that. I think we will adapt, but I think there'll be growing pains, depending on how quickly we get the integration of this. And yeah, you mentioned McDonald's. I remember, probably 6 years ago up in Montreal, walking into a McDonald's looking for the person behind the counter to order, and it was all machines. And I was just standing there looking at this saying, oh my God, I mean, this is going to change everything. You don't need the person behind the counter anymore. I can efficiently punch into the machine, give me my iced coffee. Here's how I want it. That, good or bad, and good for some people and bad for others. But I mean, the future is the future. You can complain about it all you want, but we're all going to have to figure out how to adapt to it.
Yeah, 100%. And yeah, I kind of like how you put that. You can complain all you want, but at the end of the day, you just got to deal with it at this point, right? I mean, it's happening before our eyes. And yeah, I mean, it's just something that we'll have to be in tune to. But I kind of want to pivot to the topics now of like more of the bank failures and kind of, I guess, regional banking and commercial real estate in that sense. I'm not trying to get you a full breakdown on the commercial real estate sector, but it seems like that there's been like a growing narrative around, obviously the shift to remote work, how a lot of these regional banks helped fund, maybe little small mom and pop shops purchasing some of these commercial buildings that now have 50% or even less occupancy. And, in a sense, these big commercial real estate buildings can get swallowed up by some of the big players. So is that something that I guess a trend that you're kind of, as you're like analyzing some of these, I guess, commercial real estate companies, in a sense, you said it yourself, like you're kind of short that sector, in a sense. So, is that something that I guess you're looking towards, and that's a reasoning why you're kind of short that sector? Or do you think, I guess maybe it's just like a short-term little pain, and that maybe the mom and pops or the smaller commercial real estate firms will be able to bounce back?
I think it's got the potential to be epic. Hopefully it is just a short-term thing, but I think it has the potential to be a lot worse than that. I mean, if you look at the regional banks, we live in a time when, I can transfer my entire account to JP Morgan in a matter of minutes. So, my first exposure to a bank run was watching It's a Wonderful Life, people coming in the 30s. It's a whole lot easier to have a run on the bank now. You can have a bank that looks good, be bankrupt the next day. And, if I've got an account at a regional bank that I don't need to have at a regional bank, it's not tied to something, I certainly have to do, some thinking. Hey, do I want to go over to Chase or JP Morgan or Wells Fargo? So I don't think this crisis is over. Whenever you raise interest rates as fast as we did, I like sayings, and, Warren Buffett saying, when the tide goes out, you see who's swimming naked. You see, number one, the regulators had no clue. The regulators were fighting the 2008 battle. They were worried about credit risk. What they weren't worried about was duration. And unfortunately, bonds go down for two reasons. One is credit, the other is duration. They didn't see that. The guys managing the bank portfolios didn't see that. I think that's a big problem. And then, commercial real estate, all the vacancies, the work from home, Zoom, Teams, all that stuff, I think it's got the potential to be huge. Now, that being said, the easy money has been made. I think, on the short side, it has been, and it's going to be a lot tougher. That's what I've been telling people reading my newsletter for, probably about 3 weeks now. Hey, you got to look for spots to short these things, but it's not like it was, a couple of months ago where you see a little bit of smoke, you go short, and you make 20% overnight on a short position. It's going to be a lot harder to do, but I do think this has the potential to be something epic.
Yeah, and I tend to agree. I don't know, maybe it's the doom and gloom and like the spread of information on Twitter or whatnot, but I think that in a sense could make this downfall, whether it's a recession, depression, or whatever, could make it even worse because as you kind of lined out, right? You can essentially, like, if you see any cracks, or if like Silicon Valley Bank, I forgot what executive tweeted out, but essentially tweeted out that they were looking for investors. So that sent off the red flag to all those people having money in that account. And then, obviously the bank run occurred after that. Seemingly that could happen, right? Somebody with 1 million followers or even a smaller account, and, a tweet just kind of catches wind, and all these people decide to move money out of one place or another. Can kind of cause some serious consolidation when it comes to like the overall banking system. And then, that obviously drastically affects, our small businesses and even large businesses that might have, some regional banking accounts. So, for me, I think like, although the spread of information has been good for the overall retail investor and kind of giving, the retail investor maybe a leg up and kind of evening the playing field, it seems like the spread of information could lead to or help lead to this downfall of, obviously we've seen the spread of information help when everything's going well and everything's going up, but we've never seen it when things are going bad. So do you kind of, I guess, subscribe to that theory as well, that the potential of this spread of information could make things, I guess, swing more violently in both directions?
Yeah, and this has been happening for a long time. So when I was growing up, the news was the news. It came out at what, 6 o'clock and 11 o'clock or 10 o'clock, I don't even remember. And they reported the news. There was no spin, no politicalization, no left, no right. Just this happened today, this happened today, and this happened today. Now we've got 24-hour news. We've got spin on everything. We've got right, we've got left, we've got Twitter, and we've now got, this AI stuff. So like, for example, the other day you saw, oh my God, the Pentagon is on fire. And the market sold off a little bit. And then it turned out, wait a second, that's an AI generated, image. The Pentagon is fine, but we've got all this stuff bombarding us. And unfortunately, we don't know what's real, what's fake, what's fear mongering. You've got a bunch of people talking their own book, for whatever reason. So certainly you could have a situation where a regional bank is fine and somebody goes on CNBC, Fox, Twitter, and starts talking about problems. And, all of a sudden everybody and their mother is shorting it. And everyone who's got a deposit there is running to take it out, and it becomes a self-fulfilling prophecy. That could definitely happen. And, it's unfortunate. I don't know how to guard against that. You're seeing a lot come out about, hey, we got to ban short selling. I think that is eminently stupid from a number of different standpoints. Does stuff get manipulated on the short side? Definitely. Does stuff get manipulated on the long side? All the time. You had recently all these Hong Kong IPOs that go from like 1 to 1,000 and have a market cap bigger than Coca-Cola. Yeah, okay, that's manipulated too. I mean, that's just markets. It is what it is. Let's look at the structure and see what we can do to try to fix that stuff. The answer is not banning short selling.
Yeah, and it seems like there's a lot of chatter around like market manipulation and what's kind of going on, especially now with this spread of information that we've kind of been outlining through this whole talk. But it is interesting that you're saying like, hey, markets have been kind of manipulated for a decent amount of time, right? I mean, we've had
really, if you talk about market manipulation, that's been going on forever.
Yeah. And so it's interesting that you're kind of lining it out now, but it seems like now that the retail guy is kind of, I guess, getting a leg up, so to speak, or at least like evening the playing field and not, I guess, as far behind when it comes to the spread of information. Not now that they have access to more tools that, maybe the pros only had access to at certain points in time. It's interesting that all of a sudden there's this microscope on this and the market information or the market manipulation. But I guess that's essentially how things go, right? I mean, once the small guy can kind of get a leg up and the big guys don't.
Right. Yeah, I mean, the big guys have been manipulating the market forever. I mean, look at any hedge fund and and see what they do. And also, you kind of wonder, hedge funds used to have much better performance. When did their performance start to suffer? It started to suffer when Rajaratnam got put in jail and Stevie Cohen almost got put in jail. So you kind of got to wonder about that, what was going on before that and what might not be going on now. So yeah, when the big guys manipulate the market, nobody cares. But, when you got guys on Twitter posting, hey, this bank has a problem, then the regulators are up in arms.
Yeah, 100%. So I'll wrap it up with this one last question. I know we've kind of been beating around it, but obviously, you lined out like the market isn't exactly making too much sense right now. But there's the theory around Twitter and kind of in other spaces as well that maybe we'll see like a melt up, right? Like as the market is kind of delusional in a sense, like unemployment numbers obviously are lagging, so people think that the unemployment isn't as bad. So we're kind of seeing this, the index kind of melt up throughout the year. And then, the theory is 2024, either we're going to go through some serious QE and they're going to, pull back the reins, or we're going to be in a serious recession that could eventually lead to a depression. So do you, I guess, subscribe to that theory in a sense, or how do you see this all playing out?
So I subscribe to every theory because I think you run into trouble when you say, hey, I think this is what's going to happen and this is how I'm going to invest. So, every morning I come in, see where things are, and I have my game plan for the day. And it's as simple as that. I look at the setups and the setups take me to where we're going. I do think this gets worse before it gets better. It looks like 4,200's a wall. Do we break through it? Maybe we do. I mean, maybe this whole AI thing, maybe the debt ceiling getting resolved breaks us through and we make a new trading range. I think you've got to be ready for everything. But if you said, hey, Matt, you need to have an opinion, my opinion is it gets worse before it gets better. And, we have a point where maybe we don't retest the lows, but, we start looking like we're going to retest the lows. And really everything shakes out before, we see things start to get better again. That's my thought. But again, you've got to be prepared for every eventuality. I mean, it breaks my heart reading, these smart people, perma bears on Twitter, just, selling short every rip. And every once in a while it works. But then you get a day like, yesterday and today where, these guys have to be losing tons and tons of money. And, it doesn't have to be that way.
Yeah, definitely. But Matthew, you've been so gracious with your time, so I really appreciate you coming on and discussing the markets with me here. But for those who don't know, why don't you tell them what you got going on and where they can find you?
Yeah, so we've got a couple of websites. TuttleCap.com is our main site. Our Kramer ETFs or KramerETFs.com. We have a daily newsletter that we send out with our watch list and ideas. We also every night send out our trades on the Kramer ETFs. All that stuff's free if you want to sign up. I try to do a lot on Twitter. Sometimes I get busy and I don't, but my handle's at Tuttle Capital. So, and I do troll Jim Cramer a lot. Some people find that funny. Who knows, but so go ahead and give me a follow on Twitter if you want.
Yeah, for sure. And I'll plug all those in the show notes so everybody check it out. And yeah, Matt, thanks so much, man.
All right. Thanks for having me.